Welcome to the channel JIV and CIV Made Simple. Today I am presenting IIBF CCP examination memory based question which were asked on 24th May 25. So friends, every previous year memory based question has been uploaded in our channel, and there is a playlist which I have made named IIBF CCP. I request you, if you are looking for previous year memory based question which have been for examination which has held earlier, so you can check that playlist. The link of playlist is provided in the description section. So now let's get started. Let's see the type of question that have been asked in the examination. So the first question is on your screen, and it asks you that a company has total current asset of 380 lakh, right, and total current liabilities which exclude bank borrowing of 110 lakh. If the projected net working capital is 30 lakh, what will be its MPBF? Under method number 2, clearly written method number 2, what will be the maximum permissible bank finance? So this is also called Tandon committee method number 2, which says that Tandon committee method number 2, which says that first of all we have to calculate the working capital gap. So these are the options. You pause the video, try to solve it on your own, and then see the explanation. Now let me explain. I hope you have done that. Now friends, the correct answer is option number C. Let me explain how to go about solving this problem. First of all, we calculate the working capital gap. What is working capital gap? It is the difference between total current asset and total current liability other than bank borrowing. In this case, we have 380. We have 380 lakh as the current asset, and current liability excluding bank borrowing is 110 lakh. So 380 minus 110, how much it will be? 270, right? So you can think of it like this. Suppose the company need 380 rupees worth of raw material stock, but it already owe 110 to supplier. So the actual gap or the actual shortfall is 270 lakh. So suppose the company need 380 lakh worth of raw material, stock, etc., but it already owe 110 to supplier. That is the meaning of current liability, right? So that is a kind of liability. Asset is 380, it needs use of fund, source of fund, right? So the gap is actually 270 lakh. That is where the bank steps in to help, because this total current liability indicates that what are the liability that it has to pay. So like suppose it owes some amount to someone like 110, right? So so to fulfill this gap of 270 lakh, the bank will step in. The second step after calculating the working capital gap is to deduct the borrower contribution. So what is the borrower contribution? So under method number 2, it says that borrower is required to bring some of their own money, either 25% of their current asset or projected net working capital, whichever is higher. So what is the 25% of the current asset? So total current asset is 380 lakh. 1/4 of 380 lakh is 95 lakh, and projected net working capital is only 30 lakh. So which is higher? 95 lakh is higher. As you can see the calculation, 25% of CA 95 lakh, projected NWC is 30 lakh. So which is higher? 95 lakh is higher. So we will take 95 lakh. This is the amount that borrower has to contribute from their long term fund, right? Now third step is to calculate the MPBF. So see, bank will say I have to fulfill this gap of 270 lakh, right, out of which 95 lakh will be contributed by you. The rest amount I will contribute. So 270 minus 95, which is equal to how much? 175 lakh. So 175 lakh will be the contributed by the borrower. Now let's see the option that we have. The first option say 270 lakh. No, this is wrong. Option number B say basically 270 lakh. Why it is wrong? Because that is the WCG, but the bank won't finance the entire gap. Borrower must bring some margin, right? What about 185 lakh? It is close but incorrect. This might confuse you if you use projected NWC. In the case if you use projected NWC, then you will get this answer, but this is wrong, right? Then the correct answer is 185 lakh. Yes, this is correct. So let's summarize the fact which we learned from this question is that first of all we will calculate the WCG. WCG means current asset minus current liability, and current liability should not include the bank borrowing. And under method 2, bank give MPBF is equal to WCG minus higher of 25% of CA, right? So that is the point. I hope it is clear now. Now let's see the question number 2. So question number 2 is, which of the following is considered the foremost principle of lending that the banker must prioritize before disbursing loan? Very, very important. Principle of lending question it is. Foremost. So let's understand the correct answer first. First of all, try it yourself. The correct answer is option number C, that is called safety. This is the most important principle in lending. Why? Because the bank is lending public money, that is your deposit, my deposit. So the first responsibility of a banker is to ensure that money will come back safely. Think of it like this. If you lend money to a friend, what do you care about first? Not how much interest he will pay, but whether he will return your money safely, right? Same logic apply to the bank. Now let's understand why other options are not the foremost. Option A, liquidity. Yes, liquidity is very important. It is also one of the principle of lending. It means the banks would be able to get back the money quickly in case of urgent need. But for example, giving short-term loan or loan backed by asset that can be sold quickly. But safety comes first. If a loan is a liquid but risky, it is still not good. What about profitability? See, bank is a business. They need to make profit, but profit should not come at the cost of losing the loan amount. First safety, then liquidity, then profitability. That is the order. And lastly, diversification. That means not putting all egg in one basket, like lending to different industry or different people. It is a way to reduce the risk, but again, it is a supporting strategy. Even diversified loan must be safe first. So to summarize the fact, safety is the first principle in lending. Banker must ensure that borrower is trustworthy and can repay the loan. Liquidity, profitability, diversification, these are also important, but they come after safety, right? So remember, a loan is only useful if it comes back. Friends, if you are looking for such kind of previous year question, theory, unit wise theory bullet points and MCQs based on each and every unit as prescribed by the IIBF, then we have a course on CCP available on our app. App name is JIB and CIB Made Simple. The link of app is provided in the description section of the video, or you can WhatsApp me on the number shown in the description. You will get the entire content, and many people have passed the examination using the content. Now friends, have a look at the next question. The next question is, what is the maximum default amount for an MSME to be eligible for PIRP? That is called prepacked. So PIRP is made for a smaller business, MSME. It only apply when the default amount is up to 1 crore. Right, option C. If the default is more than 1 crore, MSME have to go through a longer process, and that longer process is called CIRP. CIRP means Corporate Insolvency Resolution Process, which happen under IBC, Insolvency and Bankruptcy Code. You can think of it like this. If you owe 90 lakh, you can use the faster PIRP, but if you owe 1.5 crore, you have to go for CIRP, and CIRP takes more time and is more complex. Let's check other option. 10 lakh, 50 lakh, 10 crore, this is wrong. So what we learned from this question is that PIRP is only for MSME and default is less than 1 crore. For more than 1 crore, use CIRP. So PIRP advantage is it is faster, simpler and cost effective. Now the question is, in PIRP, who primarily initiate the resolution process and file the application? So who initiate PIRP? This is the question. Option A, debtor only. Option B, financial creditor with at least 66% voting. Option C, adjudicating authority. Option D, insolvency professional. So let's you know it very well that PIRP is a debtor in possession model. It means the MSME keeps control of the business, but the actual process start only if the financial creditor approve it. So it is a debtor in possession model, which means the MSME MSME keep control of the business, but the actual process will start only if the financial creditor approve it. So financial creditor must have at least 66% voting right in the favor of starting an PIRP. Let me give you one example. Suppose the MSME want to use PIRP, so it must first talk to its financial creditor. Let's say 3 bank gave loan, but if the bank holding 66% or more of the total loan amount say yes, then the MSME can file PIRP. So again I am repeating that if an MSME want to use PIRP, it must first talk to the financial creditor. Let's say it was funded by 3 banks, and any one bank fund more than 66% of the loan, right? Then if that particular bank say yes, you can go for it, right? You can go for PIRP, then MSME can file the PIRP. So remember, who can initiate the primarily? It is initiated by financial creditor with 66% voting. But if no financial creditor are there, the company can pass a special resolution with 75% approval. What about other option? Option number A say debtor only. So debtor can't alone, they need creditor support. Adjudicating authority only approve the plan, they don't start it. The question is regarding who initiate. Initiate means who start. Option D says insolvency professional or IP. So IP handle the process after it is initiated, not before. So IP handle the entire process after the PIRP is initiated, they don't handle it before. So this is also wrong. So correct answer is option B. So what we learned from this question is that PIRP is initiated by financial creditor with 66% voting right. MSME proposes, but creditor must approve it first. If no creditor are there, MSME can use 75% shareholder vote. Now have a look at the third question. This PIRP, last time 5 marks case study was asked based on PIRP. Have a look at the third question. What is the maximum time limit to complete the entire PIRP for MSME? Very good question. What is the time frame within which the entire PIRP for MSME must be completed? 90 days, 120 days, 180 days, 365 days. What is the answer? Please tell me. Maximum time limit. So, the whole PIRP must be finished within 120 days from the date it starts, from the date of initiation. That is option number B is correct. Also, the resolution plan must be submitted within 90 days. If it is not submitted or approved in time, the PIRP is terminated. So let me give you one example to make it more clear. Let's say day number 1, PIRP start. By day 90, resolution plan must be ready. By day 120, it must be approved. If not done, the PIRP closes, no more chance. So answer is 120 days. Had the question been when plan must be submitted, it should be in 90 days. Right. So remember the key point that PIRP must be finished within 120 days. Plan must be submitted within 90 days. It should be approved by 120 days. If you miss the deadline, process end automatically. This is very, very important. Now, full recap. Let's recap the three questions which we have done just now. First of all, PIRP limit maximum default 1 crore. That is the limit. Above 1 crore, PIRP is not there and it is applicable only for MSME. Second point, initiation. So to initiate PIRP, you need 66% vote of the financial creditor. Although it is a debtor in possession model, but it needs 66% vote of the financial creditor. Third point, time limit. It should be completed in 120 days and planned within 90 days. If you really like this easy explanation, don't forget to give a thumbs up. Now friends, have a look at the next question. Which of the following ratio is classified as solvency or leverage ratio? Very good question it is. Right, options are stock turnover ratio, debtor velocity ratio, debt equity ratio, creditor velocity ratio. So what is solvency ratio? A solvency ratio tells us if a business can pay back its long-term loan or not. Suppose a business has taken the loan. If it is able to pay back the long-term loan, that is what solvency ratio tells us. Right, it shows the financial health of the company in the long run. Remember, because the name itself says long-term loan, so obviously it shows the financial health of a business in the long term. In the long term, if you look at the debt equity ratio, which is the correct answer here. So debt equity ratio, what is the definition? What is the formula? In the numerator we write the total borrowed fund. In the denominator we write the equity, which means owner investment. So that is our leverage ratio. That is the solvency ratio. For example, let's say a company has 50 lakh in debt. It has taken 50 lakh. It has borrowed 50 lakh from the bank and rupees 20 lakh in equity. So debt equity ratio will be 50 upon 20, which is 2:1. That means company is using 2 rupee of debt for every 1 rupee of its own money. Remember, higher the solvency ratio, higher the leverage ratio, higher the risk, because more borrowed money means more pressure to repay. Let's see the other option. What about a stock turnover ratio? This is called activity ratio, not a solvency ratio. This stock turnover ratio tells us how quickly a stock is sold and replaced. For example, if a shop restock every item 5 times in a year, suppose if a shop restock item 5 times in a year, so the stock turnover ratio is 5. This shows inventory efficiency, not loan repayment ability. Here we are more focused on loan repayment ability. What about debtor velocity ratio? Debtor velocity ratio also called activity ratio. So stock turnover ratio also called activity ratio. So debtor velocity ratio shows how fast customer pay their dues to the company. For example, if customer takes 60 days to pay, so the debtor velocity is 60. Useful for managing working capital, but not about long-term loan. What about creditor velocity ratio? It measures how quickly the company paid supplier, the company paid its creditor. Right, if the company pay creditor in 45 days, so the creditor velocity is 45 days. Again, this is related to the daily operation, not solvency. So let's summarize the key fact what we have learned here. Remember, debt equity ratio is a kind of solvency ratio. It tells how much debt versus owner money is being used. It shows company long-term financial risk. Whereas stock turnover ratio, debtor velocity ratio, creditor velocity ratio, these are all kinds of activity ratio. They show efficiency, they don't show the solvency. Now have a look at the next question. Okay, this question is based on LC, how many LC to be opened, lead time 10 days, transit time 20 days, treasance period 6 months, monthly consumption of 1 crore, right, EOD end of day stock of 1 crore, how many LC needs to be opened for the year. So first of all, what you do, you add the lead time, you add the transit time, you add the usance period. This will give you the total time it takes for one LC to complete. So it will be almost 6 plus 1 month, 7 months. So it takes 7 months for one LC to be complete. Okay. Now EOQ, I think a monthly consumption they have given 1 crore, right? So total consumption upon EOD, that is 6 LC to be opened. Now what is the frequency of LC to be opened? The frequency of LC is 12 upon 6, which is 2 months. LC limit, how to calculate the LC limit? Total time, frequency of opening LC, how many outstanding LC at a particular time. So total time it takes 7 months. After every 2 months, one LC is getting obtained, right? Because we have just calculated the frequency, and once we know the frequency, just divide the total number or total time it takes to the frequency. That will give us 3.5, which is almost equal to 4. So that is the 4 LC, right? 4 LC at one particular time. And what is the outstanding LC? What is the monthly consumption? Monthly consumption is 1 crore. So 4 crore is the limit, right? Now have a look at this particular question regarding ECB, external commercial borrowing. So question is, which of the following statement is not correct as per the ECB guideline? Option A, ECB can be raised up to USD 750 million per financial year under the automatic route by all eligible borrower except a startup, which are capped at USD 3 million. Option B says ECB liability equity ratio of 7:1 is applicable if the foreign currency ECB is raised from a direct foreign equity holder under the automatic route. Option C say ECB proceed can be freely used for issuance of guarantee by Indian Bank and NBFC. Option D says that currency of ECB can be changed freely between freely convertible foreign currency, or even into INR. So these are the 4 options. Please go through it. Pause the video. Tell me which one is correct, which one is not true. That means 3 options are correct, 1 is not true. Now let's go through each and every option. First of all, let's look at option number A. So first of all, let me explain. Most eligible company can borrow up to 750 million US dollar every year from abroad under the automatic route. But under automatic route, no special RBI approval is required. But a startup has a much lower limit, that is only 3 million US dollar. So yes, this option A is true. Option A is saying the same thing, that $750 million ECB can be raised and a startup $3 million. Bilkul, absolutely correct. What about option B? See, option B says that ECB liability equity ratio of 7:1 apply if ECB is raised from foreign equity holder. This means if a foreign investor owns share in an Indian company and also give it a loan, that is ECB, then the total loan amount can be only 7 times the equity they hold. For example, if the foreign equity holder has invested 10 crore in equity, so they can only give loan up to 70 crore in ECB, not more than that. That is called liability equity ratio. Liability means how much loan they can give. Equity means how much equity they have invested. So this ratio protects the company from being overburdened with loan. So this statement is also correct. What about option C? Option C is not correct. Why? Because it said that ECB proceed can be freely used for issuance of guarantee. No, this is not allowed. You cannot use ECB fund for giving guarantee through Indian Bank or NBFC. RBI has clearly restricted this. So this is the wrong statement, and therefore this is the correct answer to our question. What about option D? Currency of ECB can be changed freely between freely convertible foreign currency or even into INR. Yes, this is correct. If a company raise ECB in, say, suppose US dollar, suppose a company raise external commercial borrowing in US dollar, right? So they can later convert into euro, yen, or even Indian rupee, as long as currencies are freely convertible. So as long as the currency are freely convertible, the currency in which ECB was raised earlier, it can be easily be converted into other. So this RBI allow this kind of flexibility. So what we learned from this question, option number A, yes, it is correct. Up to 7, general cap is to $750 million US dollar, and for a startup it is $3 million US dollar. Option B, yes, it is correct. 7:1 ratio between ECB and equity, loan and equity for foreign equity holder. C is not true. ECB cannot be used to issue guarantee, and D is true. ECB currency can be converted into INR or any other freely convertible currency. So this is the complete breakdown of this tricky ECB MCQ. So remember, ECB question is also most frequently asked in the examination. Have a look at the next one. Right, very good question it is. Have a look at it. So the question asks, which of the following correctly match the risk parameter with a description? So there are 3 risk parameter: PD, LED, LGD, EAD. So which correctly match? Option A, PD, it measures how much exposure is lost when a borrower default. LGD, it refers to the likelihood of a borrower failing to meet obligation. EAD, exposure at default, it refers to the gross loan exposure at the time of default. And option number D, PD, probability of default, it measures the amount recovered after the default occur. Again, I am showing you all the 4 options. So these are the 4 options you can see. Please try the question on your own. Now let's start with the first option. So option number A, it says that PD measures how much exposure is lost. This is incorrect, because PD stands for probability of default. It tells us how likely the borrower is to default. Simple example, suppose a borrower has 2% PD, that means 2% chance is that they might not repay the loan. But this option wrongly say that PD is about how much it is lost. No, How much it is lost is about LGD, not PD. What about LGD, loss given default? So LGD means loss given default. It tells us how much of the money we won't be able to recover if the borrower failed. Yes, we know that borrower has failed. So how much money we will not be able to recover. That is called the loss. For example, suppose LGD is 40%, and it means that we will lose 40% of the amount if the default happened. So what PD was telling? PD was telling the probability of default. What is the chance that borrower might not repay the loan? And what is LGD? We know that borrower will default. How much loss we will incur, right? But this question is talking about the probability, which is PD, not LGD. So both options are wrong. What about C, EAD? So EAD means exposure at default. It tells us how much money the bank has at risk at an exact time if the borrower default. Yes, that is called EAD. For example, if a borrower has 10 lakh loan and 2 lakh credit line is used, so EAD is 12 lakh. So this definition is exactly accurate. What about option D? PD measures amount recover after default. So this is a confusion, right? PD is not about how much we can recover. It's all about how likely we will default, right? Recovery always come from LGD, not PD. So let's quickly recap the point which we have just covered. PD means likelihood that borrower will not be able to repay. LGD, which means how much we lose if default happen. EAD, which means exposure at default, means total loan amount exposed at the time of default. So remember PD, LGD and EAD. So easy way to remember is PD means probability of default, LGD means loss after default, EAD means exposure at the time of default. P means probability, L means loss, and EAD means exposure. Just remember it. That's it. Now have a look at this particular question. Right? Have a look at it. So the question says that a project costing 20 lakh, right? A project cost 20 lakh and earn 3 lakh profit per year after charging 10% depreciation before tax at the rate 50%. What is the payback period of this project? This kind of question is asked in the examination. Options are 4.25 year, 5 year, 5.71 year and 6.50 year. Let's understand this step by step. So first of all, project cost is given 20 lakh, profit is given 3 lakh per year, right, after depreciation but before tax. Depreciation is given 10% of 3 lakh, sorry, 10% of the costing, that is 20 lakh, that is 2 lakh per year. Tax rate they have given 50%. Now first of all, what we will do, we will calculate PAT, profit after tax. How to do that? See, we are told that profit before tax is 3 lakh, right, and tax is how much? 50% of 3 lakh, which is how much? 1.5 lakh. So PAT means profit after tax will be 1.5 lakh, isn't it? So let me show you the calculation, right? So PBT is 3 lakh, tax is 50,000, tax is 1,50,000, so PAT is 1,50,000. Now add back the depreciation to get the cash inflow. Remember, this is a very crucial step, that we need to add back the depreciation. And what is depreciation? 10% of 20 lakh, which is 2 lakh. So 2 lakh we add back to PAT. So this will give us how much? This will give us 3.5 lakh. Now what is the payback period? Payback period means initial investment upon annual cash flow. So annual cash flow we have is 3.5 lakh and the initial investment was 20 lakh. So if we divide both of them, we will get 5.71 year. So let's see the option that we have. Yes, 5.71 year is the correct answer. So remember, payback period tells us how much time it takes to recover the initial investment that we made. That's why we divide the initial investment with respect to the cash inflow. That means cash inflow is the yearly cash that we are getting, right? And we have invested some amount. So how much time it will take for all the cash inflow to generate equal amount to get equal to the total investment? It will take 5.71 year. So remember, what we learned from this discussion is that depreciation. So one question you may ask me, why we have added the depreciation to the PAT? Remember, the rule is that depreciation is a kind of non-cash expense. We will add it back while calculating the cash flow. And you must remember the payback period formula: total investment upon divided by annual cash flow. Always calculate PAT, then add depreciation to find the real cash flow. Remember it. Don't take PBT, right? Now have a look at the next question. So the next question is regarding large exposure framework, LEF. Under RBI LEF, which of the following entities is not subject to LEF norm? So options are a scheduled commercial bank, urban cooperative bank, and foreign bank, and NBFC. Actually, this question is partially wrong, because NBFC with respect to the earlier syllabus, NBFC was the correct answer. But with respect to the recent amendment which is done by RBI, NBFC upper layer has also been included under the larger exposure framework. So completely we can't say that D is the correct answer. So let's skip this particular question. Now have a look at the next one. Yes. Margin of safety calculation, very important calculation. How to go about calculating the margin of safety? Selling price per unit rupees 10, variable cost per unit rupees 6, fixed cost 40,000, actual sale 80,000. What is the margin of safety? So before calculating the margin of safety, you need to calculate the break-even point. And how to calculate the break-even point? I think we have discussed. What we need to do? We need to divide the fixed cost with respect to the contribution per unit. And what is contribution per unit? Selling price minus variable cost. So selling price is 10 rupees, variable cost is 6 rupees. So contribution will be 4 rupees per unit. And what is the fixed cost? That is 40,000. 40,000 divided by 4 rupees. That will give you 10,000, isn't it? So 10,000 is the break-even point. 10,000 unit is the break-even point. And what is the actual sale? Just wait a minute, let me show you the calculation. Right, so sorry, break even, yes, 10,000. And in terms of unit, if we do, in terms, so 10,000 units, in terms of value, if we do, so one item cost how much? One item cost how much? You know, selling price is 10 per rupees. Sorry, 6 rupees. 6 rupees is the cost price, I think, variable cost, right? So just multiply this 10,000 with 10, that will give you, I think there is a mistake here, calculation mistake here. Right, there is a calculation mistake. Please, let's correct it. 10,000 multiplied by 10 will be 1 lakh. And margin of safety is the actual sale minus break-even sale. Right, which will be how much? I think actual sale is 80,000 and break-even sale is 1 lakh. So 20,000. I think there is a mistake here. So you know, margin of safety indicate how much sale can drop before the firm reaches break-even. A higher margin means a strong cushion against the loss. Now, which of the following statement is not regarding the DDA is not true? Diamond dollar account is not true. That is the question. Option A, firm dealing in cut and polished diamond can operate through DDA. Option B, a firm must have a minimum 1 year track record in diamond trade to open a DDA. Option C, minimum average annual turnover of 5 crore is required over the last 3 licensing year. Option D, Antwerp is known as the diamond capital of the world and is located in Belgium, which is not correct. That is the question. Let's understand what DDA is. You know, DDA stands for diamond dollar account. It is a special type of account in foreign currency. It is mainly for firms that import, that export diamond and diamond studded jewelry. It helps this business avoid currency conversion loss and make international trade easier. Let's check each option one by one. First of all, option number A, firm dealing in cut and polished diamond can operate through DDA. Yes, it is true. In fact, not only cut and polished diamond, even firm dealing in rough diamond or diamond studded jewelry, they are also eligible. For example, if your company export diamond ring to the US, you can use a DDA to handle payment in dollar. What about option B? Option B says a firm must have minimum 1 year track record. No, that is why this is the correct answer. This is the wrong answer, and this is the correct answer as per this question, because not true is asked. The rule is if a firm have at least 3 years of experience in importing and exporting diamond, then only you can open DDA account. So if you have been in the diamond business for just 1 year, you are not eligible. What about option C, minimum average turnover? So this is true. To qualify for DDA, your diamond trading business must have an average turnover of 5 crore or more, and this amount only serious and established player get access. What about option D, Antwerp? Antwerp is known as the diamond capital of the world. So Antwerp, you know, it is a globally very famous. So yes, it is the correct answer. It is very famous for diamond trading market. It is called the Dalal Street of the diamond world. So let's summarize the key point which we have just discussed now. First of all, firm dealing in diamond or diamond jewelry can open DDA. Minimum 5 crore turnover over the last 3 years is needed. And Antwerp is a Belgium. In Belgium is the world diamond hub. Just remember it. Now, which of the following is the key characteristics of the commercial paper in India? Commercial paper key characteristics. Option A, CP is always backed by collateral to ensure repayment. Option B, only company with a net worth of at least 5 crore and a strong dividend payment record can issue CP. Option C, the minimum size of a single CP issue is 10 lakh. Option D, CP must always be issued at face value with no discounting allowed. Tell me, which one is the key characteristics? Very good question it is. So before diving into the question, let's understand the basic. So first of all, option A, that CP is always backed by collateral. No, this is wrong, because you know CP is an unsecured money market instrument. That means no collateral is needed, and it depends on the credit worthiness of the company. You can think of it like, you know, the top rated company saying, I today, trust me, I will repay in few months without offering security. Option B say that this is based on Vagul committee. Remember the name of committee, Vagul committee recommendation. And the Vagul committee recommendation says that to issue an CP, a company minimum net worth is 5 crore. Option B, that it should have a good dividend income, record business. And finally, for example, a reputed manufacturing firm with 10 crores net worth and 3 year of regular dividend payout can issue commercial paper. What about option C? Minimum size of single CP issue is 10 lakh. So commercial paper, tell me, what are the condition must a company meet to issue commercial paper in India? Option A, it must have a debt ratio exceeding 1.5 and current ratio below 1. Option B, the company must be listed on a stock exchange and maintain a minimum net worth of 5 crore. Option C, the company must provide bank guarantee to back the CP issuance. Option D, the CP must be issued only in physical form with a stamp duty applied. चलिए, let's go through each and every option. Option number A, यहाँ पे in option number A, you can see debt ratio should not exceed 1.05, but here it is written 1.5, so this is wrong, right? Or current ratio should be at least 1.33, right? So both our options are wrong. So financial statement should be strong. If your debt are too high or liquidity is too low, you are not allowed to issue CP. Second point, option number B. So it says that company must be listed on stock exchange. So it must be listed on a stock exchange and it must have a minimum net worth of 5 crore. So yes, this is the correct answer. So this ensure only a stable company can issue CP in the market. Option number C, the company must provide bank guarantee to back the CP issuance. This is incorrect. CP is not backed by bank guarantee. It is unsecured, no guarantee, no security, only a strong reputation. Option D, CP must be issued only in physical form with a stamp duty applied. This is wrong because CP is mostly issued in demat form, just like share. And the good news is that it is exempted from stamp duty, so no extra cost here. So let's quickly recap the key points. First of all, commercial paper is an unsecured short-term instrument. It is for company with 5 crore plus net worth and good financial record. Minimum A3 rating. It is issued at discount or with interest. Minimum size is 1 crore. Issued in demat form, no collateral, no stamp duty. So that was everything you need to know about commercial paper, made easy for exam and interviews. Now have a look at this small and marginal farmer. So the question is, which of the following category is included under the definition of small and marginal farmer for priority sector lending sub-target? So definition of SMF, that is what have been asked. Option A, farmer with land holding above 2 hectare but below 5 hectare. Option B, tenant farmer and sharecropper with land holding share within 1 hectare or 1 to 2 hectare for small, 1 hectare for marginal, 1 to 2 hectare for small. Agriculture corporation with more than 50% non-farmer shareholder. Option D, loan exceeding 5 lakh to individual engaged in allied activity without land holding criteria. So tell me, which of the following categories included under the definition of small and marginal farmer? So let's look at the option number A. So this is the common confusion. Farmer with land above 2 hectare are not SMF, right? So a small and is marginal, is marginal means up to 1 hectare. Small means more than 1 hectare up to 2 hectare. So anyone with more than 2 hectare fall outside this category. Small means less than up to 1 hectare. Up to 1 hectare, marginal. Small means 1 hectare to 2 hectare. That is called small. Right. What about option B? Option B, tenant farmer. Yes, even if someone is not the landowner, for example a tenant farmer or a sharecropper, as long as they cultivate land within the SMF limit up to 2 hectare, they are included under SMF for lending purpose. For example, a landless farmer working on 0.8 hectare as tenant, they are considered marginal farmer. A sharecropper managing 1.5 hectare, they are considered a small farmer. Now option C, agriculture corporation with more than 50% non-farmer shareholding. So agriculture corporation, or company with majority of non-farm shareholder do not qualify. SMF is meant for individual or small group directly involved in farming or allied activity, not big commercial entity. So this is the case of big commercial entity. No, SMF is not given to them, right? So agriculture corporation or company with majority of non-farming shareholder do not qualify. What about option D? Loan exceeding 5 lakh to individual engaged in allied activity. So loan for allied activity like dairy, poultry or fisheries can be included, but only if the loan is up to 2 lakh and the borrower fit into the small and marginal category, right? So loan is up to 2 lakh only, but here the loan is given 5 lakh. So they are not land, and there is no land holding check. So that will not be considered as SMF. So remember, quick recap, what is SMF? Let's quickly recap it. First of all, marginal farmer is one who owns or work up to 1 hectare. A small farmer is one who owns or work work up to 1 to 2 hectare. It includes tenant farmer, sharecropper, landless labor. It help bank meet priority sector lending sub target. And what it exclude? It exclude farmer with more than 2 hectare. It exclude corporate or large firm. It exclude high ticket loan like over 5 lakh without proper land holding. So understanding who qualified as a small and marginal farmer is very, very important for CCP examination. Last time question was asked. Now have a look at this particular question. So the question is asking you, which of the following statement best describe the significant and limitation of RAROC? You know what is RAROC? Risk adjusted return on capital. So which describe the significance and limitation of RAROC? Option A, RAROC eliminate the need for other financial metric like ROE. Option B, RAROC help institution allocate capital efficiently but depend on assumptions and data, right? And option C, that RAROC is mostly used for non-financial firm. Option D, RAROC is simple and does not require much data or modeling. So RAROC stands for risk adjusted return on capital. First of all, let's look at option A. So this says that RAROC replaces metric like ROE. Yes, this is not true, right? RAROC is not a replacement but a complementary tool. You can think of it like this. ROE tells you how much return you get on shareholder equity, that is called return on equity. But RAROC tells you that how much return you are getting compared to the risk taken. You need both to make a smart financial decision. What about option B? Option B is also correct, because RAROC is used by bank or financial institution to compare profit with the risk involved in lending and investment. It helps in capital allocation, meaning where should the bank invest in money to get maximum return with minimum risk. But here is the catch: it is only as good as the data and the risk model used. If your assumptions are wrong, RAROC will give misleading result. For example, a bank is deciding between two loan proposals. One is very high risk or with high return, and the other is low risk with moderate return. So RAROC helps them choose which one is worth the risk. What about option C? Option C says that RAROC is used by non-financial firm. This is wrong, because RAROC is mainly used by bank, investment firm and other financial institution because they deal with credit risk, market risk and operational risk. What about option D? So RAROC is simple and does not need much data. That is a myth. RAROC is actually complex. It needs accurate measurement of expected loss, capital at risk, risk weighted, right, market and credit data. So a small firm without access to good data might find it hard to use RAROC effectively. So let's quickly summarize what we learned. RAROC stands for risk adjusted return on capital. It compares return versus risk. Why it is useful? Because it helps bank decide where to invest money. It supports capital allocation. It adds a risk perspective to profitability. And the limitation is that they need good data. They rely on accurate risk model, and they should be used with other metric like ROE. So the next time you hear about a bank choosing between investment, remember, it is not just about return. It's about return with risk. That is what RAROC helps them measure. So friends, that is all we need to learn from this particular chapter. That is all from which were asked. We have more questions set. If you want me to explain more, just write yes in the comment section. I will bring the part 2 lecture of this particular video, right? So these are all recollected questions which has been given by the students who have appeared in the examination. If you also appear in the examination and want to share question, please see the WhatsApp number below and you can directly WhatsApp me on this particular number with the question. I will offer you a special discount on any course, on any elective paper course or any certification course that you pursue. Thank you.